Hey everybody, Tom Gentile. Welcome to our week 2 of Optionetics Tom's Trading Essentials. This is obviously sponsored by Optionetics and powered by Tom's Trading Room. If you know, in week 1, we discussed calls and puts. We discussed all about options. I also gave you some case studies to walk away with too. Tonight, what we're going to do is we're going to get into what I call week 2, a review of week 1. We're going to review those 3 case studies we looked at last week. Also, I want to get into all about spreads. I want to review Darknet, and I want to show you something new, which is my money calendar. This is a patent-pending software that allows me to go back and find trades with 90 to 100% historical accuracy, going back a minimum of 10 years. All right. I also was taking a peek at what's on tap for money calendar for tomorrow. I think you're going to like it. It is a well-known stock, and you're going to see that later tonight. So, couple of housekeeping points before I get started. Number 1, let's scroll back over here and let's get this on the screen. So before I talk about the disclaimer, we record these sessions. I get the recordings out to you as soon as I possibly can. All right, which was going to probably be within an hour or 2 after the live event is over. Number 2, if you have questions and you're watching us live, you could submit them in the Q&A box. I can tell you right now, there's no way I can answer every single question or comment that comes in because we have such a large audience. But I will answer as many as I possibly can. If you're watching this on a recording and you have a question that you want to ask because you're an Optionetics student, you have support through us. You can email us at support@tomgentile.com as we are doing some work to the Optionetics website. All right. And then third, you got this disclaimer in front of you. And the disclaimer, you can read this from word by word from beginning to end by pushing pause on the recording that you'll be receiving after the live event. Couple of big pieces I want to point out to you before we begin. Stock and options trading has large potential rewards, but also large potential risk. The other big thing is that trading, I'd like to say trading is easy. Making money is hard in trading. All right. Also, me, Jay, everyone associated with Optionetics and Tom's Trading Room, we are here as your educators. All right. Our job is to educate you and show you what we do in the stock and options markets. And so because of that, and because we're educators, we're not your personal investment advisors. I do not, or nor does anyone on our team, under any circumstance, give you specific financial trading advice. All right, you need a broker in order to do that. You also must meet certain requirements with a brokerage firm to trade stock and options. And everything I'm going to talk about tonight is in US dollars unless noted otherwise. So tonight's agenda, again, call and put option review, Darknet review, homework and case studies. We're going to talk about vertical spreads, and we're going to talk about how we trade a money calendar. So let's go ahead and start with a call and put review. And this is going to be a rather easy call and put review because I'm not going to spend a whole lot of time on it. For a specific review on calls and puts, refer to what we did last week. What I want to do with calls and puts is I want to use last week's case studies as we review these. So we're going to be utilizing this screen right here, which is tomsoptiontools.com. Now, if you're new to us and you've never checked this site out, you're going to want to. And we're going to give you a very good way how. Just go to www.tomsoptiontools.com. And in the upper right-hand corner, you'll see a 7-day free trial. That's a full trial to everything we have right here, including our option trader, contrarian trader, and the complete trader. All right. Check it out. 7-day free trial. You can play with it as much as you want, and you'll see everything that I'm talking about last week, tonight, and even next week. So let's go ahead, and I'm going to go to Apple. So we had a call option on Apple, and if you remember, a call option is merely, again, a call option gives us the ability to buy, all right, the right to buy stock at a predetermined price for a predetermined amount of time. That's what a call option does. What we were looking at last week, if you remember, is we're looking at Apple, and we're looking at the October 27th, 155 calls. They were priced out at $3.01 last week, excuse me. So if you look at that $3.01, that equates to $301, all right? Because remember, one call is good for 100 shares of stock. So you take the entry price, you multiply that times 100, and that gives you the cost of that options contract before commissions. All right. So that is how we determine the price of our options. Now, a couple of other things you'll see on here too. You'll see something called profit. And in this case, it shows the profit from -4 to +4. That's basically the slippage between if you were to buy it at the market and sell it at the market. So it's a small slippage for Apple, but one you need to pay attention to, especially with other stocks. The other things that we will go into in more detail, and I plan on sharing this with you later on, is delta, gamma, theta, and vega. These are option Greeks. These help us determine not only the price of options, but how they move with respect to both direction and time. For instance, a delta of an option is basically how fast that option moves relative to the speed of a stock. So, for instance, if Apple moves $1, this delta says 52.77. What that means is that theoretically, this option should go up 52%, all right, of the a dollar movement in stock. So for a dollar movement in stock, this option should go up 52 cents, all right? And then you can see gamma, which is the respect of the delta of a delta. It tells us how fast this option is going to move up and down. You've got vega, which is in respect to volatility, and we'll talk about that in just a moment. And then you've got theta, which is the Greek option for time. So in this case, our call option 2 has what we call unlimited reward, unlimited upside reward, but it also has limited downside risk. So no matter how far Apple were to fall, if Apple were to take a move and go down here to $130 a share, the most you're going to lose is what you put into that option. In this case, is $300.01. All right. Now, there are some other charts that are that give us kind of the respect to volatility and theta. All right. And as you get more familiar with options, and if you want to get more familiar with Tom's option tools, we have some great videos out there that show you exactly what these mean. But I want to share a couple of things with you tonight. Each one of these lines on our volatility chart represents a different option's time to expiration. So, for instance, the red, which is the spikiest, it has the biggest moves from top to bottom. That's based on roughly 7-day options. Where if you look at the black line, right, the black line is down in here and it's moved slowly upward during this time frame. This is for the options that are greater than 90 days. So what we do is we look at the 7 to 30 day options, the 30 to 60, the 60 to 90, and greater than 90, and we're able to actually chart those, and it helps us determine when options are cheap or when they're expensive relative to their time, all right, relative to that timeline. So right now, when I look at Apple, and let me clear the board here. When I look at Apple, what it's telling me is those short-term options are cheap. The 7 to 30 day options are cheap, but the 30 to 60 day options a little more expensive. Why is that? Because something could be going on in 30 to 60 days that's forcing those options to be higher. All right, and that's something that you need to understand. Now, let's go ahead and let's pan back here for a moment. So I'm looking at my option, my Apple call options. Remember that right to buy Apple? And what we're really looking for is if Apple goes up, this should become profitable. Now, what we're looking at here is based on last week. All right, in this area it shows October 5th, 2017. That was last week. What I can do is I'm going to bring this right here. So we'll be looking at the middle of the screen. And I'm going to push plus a day. And when I push plus a day, what that does is that changes the date and shows me what this option has been doing day by day since we looked at it last week. So down $22. Let's push it again. So this is going to now show us the date of 10/9. All right. And now we're down $17. All right. So then let's push it again. And now we're looking at 10/10, down $16. Let's push it again. All right. Here's 10-11, up 17. So last night it was up a little bit. And then looking at today, which is the latest data that we have, and now we're down $27. So basically what's been going on with Apple, and you can see it right here on the screen, is it's really been doing a lot of nothing. Going back to September 22nd, it's been moving higher, all right? But over the last couple of days since we talked, it's really been jaggeding up and down, all right? Interesting to watch this. Now that we know where Apple is. So Apple is a little bit off today, okay? That's our review on call options and our review on Apple. So the biggest thing about calls is, again, they give us the right to buy. They have limited risk. They have unlimited reward up to expiration. And there are some stocks you can put these on, but then there's other ones that we would like to avoid. For instance, if I were to change this to Priceline.com, Priceline.com has call options that, I kid you not, they're $50 to $60 for one call option. You're talking $5,000 to $6,000 for one position, right? But later on in the program, I'm going to show you how we can reduce that down by looking at spreads. So, call options, we look at bullish positions to buy calls. Puts. So we were looking at puts on Bed Bath & Beyond. And Bed Bath & Beyond, we actually were looking at this is the 25 put that expires on October 20th. So we're looking at a October 20th 25 put. It was priced at $1.83 last week. Here's the risk graph. What the risk graph shows me on puts, and let me spin for a moment, is the risk graph shows that as the price of Bed Bath & Beyond goes lower, our risk graph goes more profitable, all right? So, as with calls, we make money when the market goes up. With puts, we make money when the market goes down, all right? So puts have, again, the same attributes as calls. They have limited risk, all right? They're a lower cost. They have limited risk. They do have a limitation to reward, although if you look at most textbooks, they say unlimited reward to expiration. It really is limited to the stock going to zero. But we see so few stocks going to zero during certain time frames that I like to say that it's unlimited until expiration. And there's where your limitation is. Now, let's look and see what's been going on with Bed Bath & Beyond. If you remember, we looked at Bed Bath & Beyond because it had some technical aspects to it. And it was also, I'll let you know this too, this was also something that I'm going to talk about today. Money Calendar had this as a sell. Now, if we come back up and we take a look, look right here at the chart, you can see that way up here, Bed Bath & Beyond was moving. We had an earnings report that came out, and it gapped down. And it's been kind of hugging this area right here, but really hadn't made that move back up like I would have liked it to do had I been bullish, right? But I was looking at this as a no trade until last week when we started getting signs that it might end up heading lower. So again, what we want to do with Bed Bath & Beyond, just like we did with Apple, is I want to follow this through. And this $183 position, meaning that we took a put option that costs $1.83, remember times 100 is $183. Let's go ahead and plus a day on it, and let's watch and see what happens with this one. So now the position in 1 day is up $34. It's up 18%. Come on down, you'll see there was a red candle, right? That red candle pushed ourselves to the downside a little bit. Let's push another day. And again, I'm looking right here, folks. Now we're at $91 profit, or 49% profitability, okay? This was as of the 9th of October. Let's push it again. Now, Tom's Option Tools gives us the ability to actually go back and set these things back in time and do what we call a walk forward and watch day by day how these options change. Now we're up 56%. Let's take a look at the chart one more time. Look and see what's going on here. I don't know if you can see this, but last week we were sitting in this area. Now we've come down, and now we're testing the lows that occurred when the bad earnings report came out. All right, back up to the top again, and let's go ahead and plus it one more day. This will actually, no, we're going to do it 2 more days. This is the 10th. Now we're looking at the 11th, 63% profitability. Let's hit it one more time. The latest, And this will take us to the 12th. And if I wanted to, I could just hit latest, and I could go through that entire week just like that. But I wanted to show you day by day. $190 profit, 103% return. Okay? A rule of thumb that I follow and that I teach is take half your position off if it doubles in value. So in order to take half of our position off, we would have needed to buy 2 of these contracts, all right? And that $1.83 is now, it closed today, bid $365 and offered at $380. So you can see that both the bid and the offer are right there, double what the entry price was. This is a really good textbook example of when everything comes together and it just went up and up and up and up. And so you can see here, you got $190 profit on this particular trade. We had, what, a $27 loss on Apple, which should teach you something else. Don't put all your eggs in one basket. Spread everything out and follow your rules. Okay? So that is all about puts. Now I want to show you one more, and then I'm going to take some questions. So Jay, start finding me some questions out there if there are any. I'm going to ask you for those in just a moment. But I want to go one more. Now last week we talked about darknet. And last week we looked at some darknet signals, and the one that we agreed upon was silver, the silver ETF, SLV. And if you remember, I talked about the fact that gold had been a money calendar sell. It had been a sell of ours for quite some time. Well, that sell came off the table last week. And all of a sudden, we started seeing a lot of silver stocks and silver itself showing up on darknet. Darknet, if I were to kind of wrap this all up into one review, darknet is our channel collision indicators. And it tells us when we see long, short, and intermediate term channels finding support points that give us buying opportunities. And so those buying opportunities are typically 30-day trades. Now, SLV, we looked at the 15 calls, 75 cents. That's what they were trading for last week. Very, very cheap. And so we saw the spread was really good, 74 by 76. Really, really tight spread. All right. And you look at the chart, and I remember talking about last week that we had an uptrend that was broken, but it's been creating this kind of cup and handle formation. And is it possible that we had a low and a high, and now we have a low, and possibly could we have another higher high? Somewhere up here around 18. All right, so let's go ahead and just see what it's done for the week with our call option. Again, what I'm going to do is I'm going to come up here. Actually, all I'm going to do is I'm just going to hit latest. We're not going to look at it day by day. $75 now shows a $53 profit, or a 70% profit return. Take a look at the chart. This is the big move that's happened in 5 days. We've gone from around 15, call it 15 and a half, maybe a little bit more than 15 and a half. Now we're up, and we closed at $16.16. So we've only moved 50 cents, maybe 60 cents move on silver. And we've managed to collect at a 60-cent move in silver. We've collected $53 out of a 60-cent move, out of a $60 move in 100 shares of stock. All right. I want to show you something about Delta. If the stock moves 60 cents and you get 53 out of 60, you have a high delta. What is your delta? Well, we can just spin around here and look. Let me spin around so you can see it. 95.85. That tells us that this option is moving very, very much like a stock. All right. So that's calls, puts, darknet all rolled into our review. Jay, any questions?
Brian was asking if you can explain a little bit more of the upper left chart there with the open, high, low, and close.
The upper left chart. We're talking about right here?
Right there. Yes, sir.
Absolutely. So what we've got here is, this is actually very, very simple. This is all based on the day on the hard right edge that you're looking at here. So this is today's date. And you see that the close, open, high, and low are referring to that particular share, those particular stock shares. So SLV, which is the iShares Silver Trust, it closed at 1626. It opened at 1622, and it had a high of 1630, and it had a low of 1616. And we'll look at this again when we dive into our spreads and we look at what's going on there with spreads.
Thank you. And again, just a reminder, folks, that this is being recorded, and Tom will send out the link for the recording after the session.
Absolutely.
Okay, what's your rule of thumb on how to manage the remaining half? After you take off half at a double, what's the rule on the other half?
Okay, so one of the big things with option traders is it's easy to get into a trade. It's always hard to get out, and that's probably the case with every trade. Easy to get in, hard to get out. So you got to think about a couple of things. Number one, you're using an expiration date where if you don't get out, you're going to be forced out by expiration. But I don't like that. What I like to do is I like to get an idea of what my average move is. What's my average move in this trade? Number one, I can get out of half when it doubles in value, but what about the other half? The other half has to have some hard stop. Most of the time I use time stops. All right. So for instance, I'm going to show you an example of a time stop real soon. But Darknet, for instance, is a strategy that actually is a 20 trading day strategy. So if you would have run all the way to 20 days, that's a hard line stop. All right. The money calendar. The money calendar actually shows, and I'll show you this in a moment, it shows both average move over the last 10 years for a particular stock and its start and end date. So that's good too. But anywhere in the middle there, if I'm moving along, for instance, I had a trade on Johnson & Johnson earlier this week. In literally one day, the options doubled in value. So take half of it off. Even though it's a 30-day money calendar trade, one day the thing doubled in value. American Airlines is another one that I had, this was a couple weeks ago. And it was a 30-day trade too. Yet, within about 2 weeks, American Airlines had gone off to the races. In fact, earlier this week, it was the number one biggest gainer. Well, that was also the time that these options doubled in value. You take half off when it doubles in value. You know why? Now you've taken your money back, and everything left over is profit. And that will make you less emotional on the actual trade itself. Same thing goes with ETFs. SPY, I had a position on SPY. This was a week ago, a little bit more than a week ago. And I ran into this, where you take half off and it still keeps going. By the end of that trade, I'd already had about 300% on my SPY calls. So take half off. The other half, have an exit plan. Typically, my exit plan is time. And I'm going to show you how we determine that here later tonight. All right. So once again, we had what? We had a plus 53 per contract. Let's put those up over here. So 53. We had 190. That was Bed Bath & Beyond. And we had minus 27. So this is all, when you take a look at this, we're talking about, spreading out. And you spread out your trades. To me, I like spreading my trades out on across time. So I don't like to do them all at once. All right. The second thing is I had a bull here, I had a bear here, and I had a dark net. All right. So I like to find, I don't want to be a master of one idea and that idea only, because eventually, it could break down. So become a master of two or three. Become a jack of all trades, or I like to call it all trading strategies, and become a master of two or three. And that way you've always got something there that's going to allow you for what I like to call a nice smooth equity curve as we move higher. Okay, let's slide back and let's talk about call and put spreads. So call and put spreads are very similar to calls and puts, but what we're doing is we're utilizing the ability to finance a portion of the trade. So let's talk about bull call spreads. Bull call spreads involve trading more than one option simultaneously. And so what we're doing is we're trading two different call strikes together as one trade. It lowers the overall cost of your trade. It will lower the overall risk of your trade. And then finally, it will also lower your fluctuation, your day-to-day fluctuation. So imagine if you happen to be in Priceline.com, which was it earlier this week? Yeah. Earlier this week, this thing was trading at close to $19.50. And then it broke down below $19.00. This thing was down $50 inside of 2 days. So you could see that if you had a 50-point call spread, that $50 call spread could be worth $25 2 days later. That's 25 points of loss. That's a big fluctuation. But by using a spread, we could slow down that fluctuation and not even get involved in something that costs $50 to begin with. An example here, let's say that we're looking at XYZ. So XYZ is a call spread. An example would be buying the lower strike call, selling a higher strike call. In this case, if we bought a 100 and sold a 120. This is what we call the 100-120 call spread. Now, let's say the 100 call costs 10 and the 120 call costs 5. I would be paying 10 for the 100 call, and I would be selling the 120 call for 5, so my net difference would be a debit of $5, right? That's how we can take a trade and bring it down to be much lower than just the overall call option itself. And while this is just an example, if you look at stocks like Amazon, Netflix, most of the FANG stocks, all right, with the exception of Apple, Google, Priceline.com, these are all stocks that have options that are expensive. When you're going 30-day, you're looking at 30-day or greater options. They're going to be expensive. This is one of the best ways to still take a bullish or bearish position on that underlying stock, but being able to do so without putting up 20, 30, 40, 50 points per option trade. The risk graph on an option, like a spread, is going to look like this. You're going to have limited risk. That's what you see on the left-hand side. All right? You'll have a break even, which is basically the difference of where you bought that spread, and you take the price of that spread and add that to the lower strike, and that's going to give you your break even. And then you've got out here what we call our maximum profit area. So limited risk. Here's the problem, limited reward. But you have to, what you're giving up is you're giving up unlimited reward. What are you getting in return? A much lower cost options trade. All right? So if we were to look at, for instance, say XYZ at 100, if the stock goes from 100 to 120, here's what it's going to look like. The stock buyer is risking $10,000 to make $2,000, 20% return. The call trader, in this case, would buy the calls for $1,000, but that $1,000 would double in value, 100% return. Great. The spread trader could actually make even more because the spread trader bought the 100-120 call spread and only paid $5 for it, and it had a maximum $1,500 return on $500 of risk, or 300%. Now, let's look at it the other way. Let's say that this trade goes upside down, and it goes from 100 to 50. If you own the stock, you just lost $5,000. If you own the call, well, the most you can lose on the call is what you paid for it, so you'll lose $1,000 on the call. If you had the call spread, you're going to lose money on it too, but you're only going to lose $500 because you paid less for the spread. So in a real weird silver lining way, owning the spread ended up having less risk than the call or, of course, the stock itself. All right? Put spreads are just like call spreads. Now, the only difference is that put spreads are used for bearish opportunities. So when options are too expensive, you look at those to the downside, and every once in a while we see those. All right. I know a lot of traders out there are looking at Tesla Motors, and they're saying, wow, I don't get this. I mean, they're practically giving these cars away. This guy's got rocket ships going in places. He's doing trying to do the galactic spaceship, and is he making any money? You know, and to me, the money in Tesla is actually in the batteries. I don't think it's in the technology, unless you plan on selling the company. But there's a lot of traders out there that think Tesla's overvalued. And this would be a good way, an example, good way to look at Tesla for a potential move to the downside. Now, I'm not suggesting Tesla's going up or down. I'm just giving you an example of how you could do that with a high-priced stock using a put spread. What you do is you would buy the higher strike and sell the lower strike puts. Use the same expiration date on that stock or ETF if it's an ETF. Again, like a call spread, you're going to see lower cost, higher reward, and higher profit potential, right, with that trade. Now, I want to show you how you can choose that perfect spread. Before I do, though, what we can do is, let's see if we can work out something with spreads. And to do so, what I'm going to do is I want to show you how we bring them up and look at them on Tom's Option Tools. So, hey, welcome back. In this case, what I'm going to do is I'm going to need to go to my other computer, and I want to take a look at, because Apple's actually a stock that doesn't really need a put spread involved in it. Let's take a look at an example. Let's let's look at Priceline.com. All right. Now, I'll say this right now. I'm neither bullish nor bearish on Priceline.com. This is just an example. All right. This is not something that I'm just going to show you how big the difference is between buying puts on. Well, no, you know what? Let's look at Tesla, because a lot of people think Tesla is a bearish indicator right now, bear stock. So what we're going to do is we're going to type in, I'm going to go over here where it says Apple, and I'm going to type in TSLA. Now, you can do this on any broker's feed. You don't really need to do it on Tom's Option Tools, but I'm just showing you how we have it set up. Now, let's take a look and see. This is the October 13. Those will expire in 1 day. That's tomorrow. But then I've got Oct 20s, Oct 27s. Let's go to November 17th. The November 17th are the third Friday in November. I'm going to click on Update. And now it's going to update my strikes, and I can just scroll down and look at what I have to work with Tesla. Here's the stock price, $355.68. Take a look at the November 350 puts. All right, they're trading for $15.48. That would be $1,500 for that put. If I want to risk no more than $500, what can I do? Well, for every one of these that I'm going to buy, I'm going to sell one down the pipe. So maybe I buy the 350 and I sell the 340. And if I sell the 340, I'm going to put a -1 there. That's going for $11.45. So 12, 13, 14, 15. We can do that trade for a little bit more than $400. All right. Let me go ahead and plug it into the computer, and let's see what it looks like. So again, buying the 350 put and selling the 340 put. Now, I'm actually going to show you one that I think looks good to the downside. It's not Tesla. Tesla's just an example. I know I said that before, but I have to say it a couple of times with you. Now, watch this example be really good for us next week, but it is just an example. Take a look at, well, first of all, take a look at Tesla's, let's scroll up a little bit here. Look at the chart. I mean, it's flatlining up here at around the 390 area. You've got support down here around 300. This is a 90-point range. The other thing I noticed is that our higher or lower, our higher lows and higher lows got squashed. All right. So we've had this trend channel that's kind of been in force since June 28th. It got broken down right here around September 23rd, and now what's happening is the channel's being used as resistance. I believe if we come back in and we fall below the 340 area, that might make room for a big move to the downside. All right, just a little bit of technical analysis I wanted to share with you. The trade we have here shows that if Tesla goes up and we're wrong, the most we can lose, all you do is just come down here. You can see $400. All right. But if Tesla were to have a higher, that lower high, lower low, lower high, and then it drops down here, then what we do is if we're down here around let's call it the 325 area, it comes down to 325. You just move over to the right and you can see where the profit comes in. If it happens tomorrow, theoretically, you're going to make about $250. If it happens in the next week, then theoretically, you're going to make about $400. And if it happens to occur at or near expiration, let me move out of the way, I'm sorry, then you have a profit potential of $600. So risking 4, making 6. How did I come up with those numbers? It's very simple. If you look here, let me scroll down. I'm actually going to clear the screen. Get rid of all the red noise that's there. Okay, and what you'll see is that we have a 10-point spread. All right, so 350 minus 340 is 10. How much did we pay for that 10-point spread? We paid $403. Let's just round it to $4 for the spread. So 10 minus 4 gives you a maximum profit potential in points of 6. $400 maximum risk, $600 maximum reward. That's how you come up with the spread. So the spread's risk is going to be what you pay for the spread. The reward you calculate by looking at the distance between what you bought and what you sold and subtract out what you paid for the spread. Okay? So that's an example of a spread trade. Yes, Jay?
Question is coming if you can explain the delta of the spread.
Sure. So if you look at the delta here, the delta that I'm seeing on the screen right now is minus 8.12. So minus 8 is basically means that if we get a $1 move today, if we get a $1 move to the downside, that this spread is going to move up by 8 cents. All right? A spread is known as a maturing trade. It means that you need to have this trade. It really needs time in order to work out. Notice we have 36 days to expiration. On day one, you get that dollar move. I mean, you're looking at almost nothing on the screen. All right, we get $10 movement. You know, maybe we're going to be down around the around this particular area where maybe we're up about $50. Okay, but as time goes on and as price marches on, that's going to raise or lower that delta value. That delta value you see there is based on the entire spread, not on the individual option legs. Okay, so let's go back to the screen here for a moment. And you can see here when we talk about looking at calls, puts, call spreads, put spreads. You know, I used to say this at Optionetics events all the time. In fact, a lot of the instructors picked this up and they started using it as well. I used to have this saying: if you were a losing stock trader, if you didn't have a way to make money in stocks and you decided to turn to options, options are just going to allow you to lose money slower. All right. What that basically means is that you need to have a three-pronged attack to be a consistently successful trader. Number one, spot opportunity. That has absolutely nothing to do with options. It has to do with the underlying, because you make money off an option based on what the underlying does or does not do. So you need to spot the opportunity. That's your trading system. Then, when you spot that opportunity, then you look at the low-risk trade, which is options/spreads. And those spreads could be bullish, bearish, neutral. They could be breakout. There's so many different ways you can go. Next week, we're going to talk about how you can create a neutral trading strategy where I can take the management of something. Let's say that there's a trade that costs $1,000. All right, I can bring it down to $400 or $500 with a spread. Next week, I'm going to show you how to cut that trade all the way down to where it's $100 or less. Okay, we're going to do that using something called butterflies. But again, all of these rely upon these three things. Number one, spot the opportunity. Number two, create the low-risk trade. Number three, plan, execute, and manage that trade. And so before I get into questions on this, because we've already kind of gone through a few questions, let me show you how we spot opportunities with something that I call the money calendar. So the money calendar is something that I started working on this years ago. And I had a good friend, programmer, who I've known since the 90s. Since literally when Optionetics was born. Me and this guy have been friends and coworkers for a long time. He actually went to work for a company called TradeStation. And he and I were really good friends. We started working on this project several years ago. And we call it the money calendar because it has to do a lot with seasonality. But there are some seasonal traders out there. They're in the commodity field. What we did was we found patterns in stocks. And we're able to, with an algorithm, a particular type of algorithm, which is that's the whole piece of the patent there. We're able to go in there and with 10 years of historical data, we find these short-term patterns. And the funny thing is the reason nobody else can do it is because nobody else knows how to account for weekends and holidays and how to adjust. We do. And that's the valuable piece of what it is we do. That and all the data that we have. And so, you know, this is what I call so valuable that we went to apply for a patent on it. We're being in the process of getting a utility patent for this. So what it does is, I like to say it follows all my golden rules. Number one, it identifies trade opportunities specifically designed to double your money every single day. All right, not just every single week. And I'm going to show you that in a moment. It shows high probability trades where money calendar patterns have appeared in 9 of the last 10 years, and even 10 of 10. And then finally, it pinpoints what we call these payout appointments in the 30-day or less time frame. Now I'm going to show you how in just a moment. So what I look at is I get this monthly view first. We're going to see this live. I'm going to show you one example here on the screen, and then we're going to look at it and see what's going on tomorrow. So from here, I'll take a look. I'll pop in on a calendar. So it looks just like a calendar. Each one of these days is loaded up with the day's best bulls and the day's best bears. All right. Now, in order for it to even show up on my screen, it has to have at least a 90% or better success rate. So you can imagine how many stocks it calls through and how many it throws out. From there, I'll jump on the day and I'll look inside the day. And I will judge based on the day, based on a couple of things. I'm going to show you how I do it tonight, which ones I find are the best ones. All right. From there, I'll highlight that trade and I'll immediately get some information. I'll get my start day. I'll get my end day. I'll get my average profit per pattern. And then I'll get my accuracy as well. But I'm also looking to see what that pattern is doing between when we started researching it and last year. Then it's just a matter of looking at the trade length, if it's bullish or bearish, and then creating that trade. And here we created the trade using, guess what? Tom's Option Tools. I just showed you this, but I showed you this using other stocks. From here, we'll create that trade, and then it's just a matter of looking for that low risk, high profit potential. All right. In this case, we had a trade. This trade was in IBM. This was the IBM 170 calls. They costed $3.85, and the stock increased just about 5%, but the options at that time actually were quite large. So what I'm going to do is I'm going to switch over to the live screen. And what I want to do now is I'm going to move over to the money calendar. I'm going to move over on this side. And so here we are. So like I said, it looks just like, and I'm right in Tom's Option Tools, and I went into our money calendar piece, and I actually brought up the month. So I'm looking at the money calendar month. This is October 2017. And here is tonight, October 12th, but that day's gone. Let's look at Friday the 13th. Dare I even say it? All right, I click on Friday the 13th. Here's all the data that's coming up tomorrow on trades that have potentials, 90% or better. So what I can do is I can sort these a number of different ways. All right. I have them sorted right now based on an algorithm that gives me an idea which ones may look good to start with. But I like to sort them a couple of different ways. Number one, I can look at accuracy. And if I double tap accuracy, I can see, check this out, Baidu, Oracle, Baidu and Oracle were 10 for 10. That means the last 10 years, we've actually had, let's take a look at Baidu for a moment. I'm going to click on Baidu, and here's the trade, and it shows it is a 12-day trade. That's 12 trading days. All right. The other thing I notice is that I see that the average trade netted a profit of $5.90, 100% accuracy, the last 10 years, maximum drawdown. That means how far did it go against you when the pattern started? Well, it went down $11.12, but look at the maximum profit potential, $21.90. This is actually a good looking trade. It has a 2-to-1 run up to drawdown. This is good stuff. Now, take a look here. This is the next thing I focus on, is I look at what the yearly trade results have. 2007, the trade actually made $1.40 during that time frame. 2008, $2.51. 2009, $2.16. Look at 2010. $9.74 is where that pattern went from beginning to end. Then it popped back a little on 2011. 2012, we had $5.49. 2013, $3. 2014 had its biggest gains at $14.72. 2015, $11.01. And last year, the pattern between tomorrow and going forward was $7.56. I'm sure you guys want to see this one more time. You're probably most interested in the trade length. The trade date starts October 13th and runs to October 24th. All right. Baidu, which is the Google of China, I believe. So there you go. I spend so much of my time looking through these. And by the way, when you click on any of these bars right here, you'll see below that, you actually see the chart from start to finish. All right, that was 2015. Look at 2016. You can see here from start to finish. Look what happened. We had a day where we moved up, and then we pretty much moved sideways for the week, and then we moved higher on that final day. All right, so that was the trade pattern for last year. But the patterns look really good on this particular stock. I might say that if we were to go and actually look at this stock, let's see if I can find okay, let's go backwards. Here we go. Instead of looking at Tesla, let's go look at Baidu. BIDU. Now, BIDU might make a good vertical spread, or it might not. Okay, so remember that question that was told to me, when do you get out of your second half, or when do you look for an exit? This is actually really easy if you utilize this type of a strategy, because you already know where your exit's going to be. It's going to be on or before October 24th, 2017. All right, because that's the end of the pattern. So I want to look for options that expire on October 24th or later. Well, the 20th is before the ending pattern, so we can't do that one. But the 27th looks good. So let's do 27th. Let's update, and let's see what we're working with here. All right, so left-hand side is calls, so I'm going to stay right where I am right here. So if you look here, this stock is at $259.33 as of last night. If you're looking at the trade, well, the 260 calls are $855. That's $855. If you want to stay at or below that $500 level, this now starts to look pretty good. And what I mean by that is that we could look at buying, and I'm going to go ahead and type this in over here. So I'm going to buy a 260 call, and I'm going to look to sell the 270 call. So that's a -1 I'm going to put into that category. So buy the 260s, sell the 270s. Let's look at a risk graph. And so remember, the 260 calls were too expensive to just purchase on their own. But if you did the 260, 270 call spread, now we're able to do this for $3. Now look, you're buying the 260 call and you're paying $8.55. You're selling the 270 call, you're getting $4.78. So a combined price of $377 or $377 before commissions. All right, so that's an example of a good call spread using what? Spotting the opportunity, creating the low risk trade, and now all there is to do is plan, execute, and manage the trade. That was a great example. That was one I was not actually looking at showing you tonight, but it's a great example nonetheless. Let me show you what I was looking at tonight on this, now that we've looked at both spreads and the money calendar together. Go back to the money calendar. I'm going to go back to the day. I'm going to view the day. This is another way I'll sort this. So I showed you sorting methods using accuracy, but I want to come over here to something called Power Meter. And I'm going to double click on Power Meter. Anything that's above 1 that's a positive number is good. But look what's all the way up at the top here. There's a 224 and a 202. Google and Google. GOOG and GOOGL. Now of the two, I like GOOGL. That's the one where that's the active one of the two. So I'm going to click on GOOGL. Now this is one that has a buy date of tomorrow and a sell date or an end date of October 30th. It's bullish. I know that because everything is green. The other thing that I want to look at is I want to look at our stats. The stats look like this. 12-day trade. Average trade makes $23.58. 90% accuracy. Look at the drawdown. Now, this is why you need spreads. Drawdown, 41 points. Run up, 87 points. Nearly actually better than 2-to-1. And then you got this right here. All right, this is what we're interested in looking at. Let's take a look at it real quick. And I see my yearly trade results. The 1 year did not work out. Let's look at that first. Minus $35.81. Again, there are no guarantees. Anyone that's found a 100% trading system going forward, I haven't seen it yet. If you have it, feel free to let me know. I think we could partner up together on something. But you know what? Until then, I've got to use what I find works as good as possible. And for me, even though nothing's a guarantee, when I see the same thing happening over and over again, that's where I gravitate to. And so last year, 1349. Year before that, 6112. 2014, 831. 2013, 8488. What I'm looking for, and I think you can see it here, is an average move going in the upward direction. All right, that is where we see more and more patterns coming into play. In this case, we see the patterns on this particular stock. So let's go take a look at it. Pop on over. Oh, before we do, remember the date. That's probably one of the most important things we want to look at. I look at two things to determine the trade. Number one, where is the ending date? October 30th. Good, I can remember that. Number two, what is our average trade look like? Now, I do two things. I look at the average trade, but the average trade also includes the years back here when Google was not as high priced as it was. So I do give myself a little more weighting over here. The weighting over here tells me the average trade is something more like $40. So think of this, October 30, that's the end date. 40, that's my target. 40 above where we are now. Go to stock price. Now I'm going to
Hey,
type
Tom,
in
if I can
Google.
interject here real quick.
Yes, sir.
One other thing you've taught me as well is that power meter, even though we just need a positive number over one, the size of the number isn't so much the concern. But what you just pointed out is that power meter is gauging that average profit move average in the recent 3 to 4 years versus the 10 overall. So
it is most definitely. Now I'm looking at a table of Google, GOOGL. I put into the top area here. I know I need something bigger than October 13, 20, 27. It's October 30th, so I could literally go to November 3. But I want to show you one more thing that I do too. This is where experience will teach you these things. And as you gain more and more experience as an option trader, this will pop up. What is the most liquid option of an entire month series? I think I talked about this last week. Does anybody know? What if I were looking at all the weekly options in November, which one has the most liquidity? You should remember this. It's the week 3 option. The week 3 option is 3rd, 10, 17, the 17th. So we're going to take a look at each of these. All right? We'll take a look at each. And so I'm going to go ahead and click on update. This is going to take me out there to all of our Google options, and there's going to be several of them. I just want to show you real quick. We're going to determine whether we're going to use those November 3rd options or those November 17 options. All right, here's Google, priced at just over $1,000. Let's look at the 1005 or the 1005 calls. 26 by 29. That is a 3-point difference between the bid and the offer on the options that expire on the 3rd. Now let's go look at the 1005s for November 17th and see. And what I'm looking for is I'm looking to see if the bid and the offer is closer together. 1005s, 3220 by 3390, about half the distance. So even though the trade ends October 30th, it makes more sense to use the October or the November week 3 options. So that's what we'll look at. All right, so now that we got our time situation worked out, what was our average move we were looking for? Remember, 40 points. So 40 points above where we are now. So let's take a look at, let's just take a look at the 10 10s, all right? 20, 30, 40, 50. So around the 1045 area, right down here, this is our target. This is where we expect Google to go between now and the end of October. All right? Google is here. The target is there. We want to be looking at buying. We can sell the target, and I totally like that idea. Let's look at selling the 1045s. But now we want to try to buy a little closer in. All right? Maybe we buy the 1035s. Or maybe we buy the 1025s. If you buy the 1035, you're looking at paying $19.80 and selling for $16.75. It's a little bit more than a 3-point move. So you're risking 3 to make what? 7. Now, if you want to move a little closer, you could look at the 1025s. All right, so maybe we look at the 1025, and that's $23.90. So you're looking at $23.90, that would be 16, 17, 18, 19, 20, 21, 22, 23. You're going to be paying about 7 points, which is over my 5 limit. So let's take a look at maybe perhaps if you want to be more conservative, why don't we get rid of this? Let's move ourselves inside the target. How about the 1025, 1035? You're looking at a price difference of about 4 points. This might be the sweet spot right here. So what I'm going to do is I'm going to look at buying the November 1025 calls, selling the November 1035 calls. I'm going to plug those in and get all the data that I need to get right here. So buying 1025s, selling 1035s, and then it's just a matter of I know what I'm buying, I know what I'm selling. I'm going to scroll down, hit my risk graph button. And now I'm going to see a risk graph that appears on the screen that $410. I was close. I thought it was going to be 400. Here's what your trade looks like. Buying the 1025 calls for November 17th, selling the 1035 calls for November 17th. Move on over. Here is our risk. All right, what is our risk? Let me scroll down just a little bit more. A little more than $400, as we know. The maximum reward is right over here, and it's very close to 6. All right, so what we've done is, for those of you that are new to this, and some of you are, what we've done is we've taken a $1,000 stock, all right, which for 100 shares, you're looking at $100,000 for this to buy the stock at today's price, over 100 grand. So I mean, I can start right over here, 100,000. Now, what if we bought those call options that we were looking at? Those call options are significantly reduced. I think they were 23, 24 points. Let's just call it 24. So that would be a $2,400 position, much cheaper than 100 grand. But what we were able to do for $400 is leverage $100,000 in stock between the price tag of 1025 and 1035. So we're really renting that stock between now, and we have until, if we wanted to be, until the middle of November. But again, our rules state that we want to be out when the pattern is over. And when is the pattern over? October 30th. Jay, any questions?
Well, the big thing that's dominating the Q&A boards is that October 26th is the earnings. And so if you want to address the earnings on these, regardless of a money calendar pattern and an end date, earnings kind of trumps that a bit, wouldn't you say? And
it
would you want to speak to
that? It absolutely does. And you know, I'm a big believer in, if you want to avoid the volatility, you get out before the earnings. But the other thing we could do is, have we even looked to see what this stock does around earnings? And you know what I'm going to do? I'm actually going to stay on the board here. I'm going to go over to another area. And if you go to stocks, you go to stock analysis. I did something with this very, very recently, where you can go into stock analysis and you can come down to what's called earnings effects. And the earnings effects, we can actually take a look at Google. So type in GOOGL in the stock symbol area. And I want you to go over to where it says stock price and IV change wizards. Now, there's two areas that I think are very important to look at. And that is, if you look at down here where it says price, best change before for earnings. Click on the search button. Down here, it's going to give you all the information you want to know about Google. And in this case, let me just blow it up so we can see it. Google tends to move an average of just under 3% before the earnings come out. All right, so we're looking at like a 3% move. That's actually good information. And look here, 3 of the last 4 quarters, those moves have been positive. At one time, it was negative. Now, I show you this because this is really not bad. I mean, you're looking at something, you're thinking, wow, as we go into earnings, typically this thing moves up by an average of about 3%. It has moved down 1%, but this is a really good reward to risk ratio on looking at something pre-earnings. Let's look and see what it does after earnings. So just click on price best change after for earnings and then hit search, and let's see what it does then. All right, now it still moves 3% after earnings, but look, -3, +5, -2, +3. So all of a sudden now it swings to like, there's a 50-50 chance it's going to go up or down. Now, as a stock trader, that's good to know. As an option trader, it's even more important to look at IV. So your IV is really going to give you an idea of what the option prices do before and after earnings. So let's click on IV best change before for earnings. Click on search. And you see here, now this is interesting. Last quarter, the options moved up 33% before the earnings. But then there was a quarter they moved down 10. There was a quarter they moved up 7. There was a quarter they moved down 8. But typically they tend to stay in that upward move. Look what happens when you hang on to the options after the earnings report comes out. I think it's a pretty clear example of what ends up happening. -51, -50, -47, -44. So the time premium in the options typically drops in half after earnings. So those of you that were asking that question about IV, here's the thing. If you really are an astute trader and you're trading this trade, you're looking at this Google trade, and let me bring it back up on the screen for a moment. If you're looking at this Google trade and you're trying to determine whether to get out of the way with earnings, if you followed this correctly, let me move over to this side for a moment. Get rid of this. Let me spin. We need to be above 10. We really need to be above 10. What is it? 1035? Let's go back and take a look at it. We need to be above 1035. If we're above 1035 on that trade, oh, I'm back on my other screen now. If we're above 1035 on the trade, like right up in this area, this is good. If we're above 1035, then think about this. You got two strikes you got to worry about. 1025, that's what you're long. 1035, that's what you're short. All right. If before earnings, if you're down here, if you're below 1025 before earnings, it's best to get out, because you know what's going to happen. Both of these are going to drop in time premium once the earnings are announced. If you're above 1035, all right, and you're in the money on both of these, you want time premium to go down. You might consider taking half the position off or even outright staying in through earnings, because if the time premium drops on this trade and you're in the money on both sides, it's going to widen your spread very quickly. So a lot of that has to do with where we are on October 26th. All right. Any other questions, Jay, before I do some summary?
Well, if you want to address an IB crush, there is a question in regards to, isn't the IB crush less with the spread?
It is going to be less for the spread. It's less because you're crushing on the side you buy, that's against you. You're crushing on the side you sell, that's in your favor. But again, if you're out of the money, you paid more for what you bought than what you sold. So it's going to be a net effect that's going to be minus to you. But if you're in the money, what you bought and what you sold is going to be a net positive effect for you. That's why I like to see where am I before the earnings are announced. All right. Homework this week. So we have a couple case studies I want you to follow. I want you to follow the Baidu trade that I showed you, and I want you to also look at the Google trade. Those two trades that we have on the board. You know what? Before I let you guys go, though, let's look at one more thing that I completely overlooked. And if I look up here long enough, I might be able to find it. There it is. Darknet. Somehow I rolled right through and I didn't give you any idea what was going on with Darknet. So Darknet has quite a few stocks on here tonight. I ran this after the close, so I'm seeing Campbell Soup. I got an oil and gas company. I got Xerox, Kohl's, HCP, Macy's, Activision, Geo, Hub, Canadian Solar, and Nordstrom. Do you see the pattern tonight? Does anybody see the pattern tonight? Jay, do you see the pattern tonight?
Let me quit answering all these questions and try to take a look.
I'm gonna look at a few patterns.
I'm going to say retail.
Yes, Kohl's, Macy's, Nordstrom. Maybe you can call Activision one of these too, but it's really not. But I mean, you got some retailers in here that are doing some interesting things. Let's take a look at KSS. I click on KSS, and you can see all the way over here on this side, we've got that higher low, higher high scenario going on, and we got a buy right out here with Darknet. All right, good to know. Also, if you look at Macy's, I'm going to plug Macy's in here. Now, I still have the same drawings up here from the one before. Macy's is completely different. Macy's is a company that just keeps going lower and lower. However, it looks like maybe we've put in some sort of a double bottom in this area. And the last buy that was on Macy's actually ended up going up a couple of points. Now, these options are going to be extremely cheap because we're talking about a stock that's trading around $20. All right. Let's take a look at the final one. Notice all I got to do is just type on the chart. If I activate a chart, I just click on the actual stock ticker, and away we go. Nordstrom. Again, here's another one that has lower highs and lower lows. There was a buy signal that was activated back here in August. This is an R. An R stands for rebuy. It's another buy-in. And so one of the things you'll see with Darknet is it can go up to 3 levels deep. Buy, rebuy, and add-on. Okay? Of these three, remember we looked at silver stocks last week, and we liked SLV. It made the most sense. What makes the most sense here? I have to say, of those three, KSS, Kohl's makes the most sense because it seems to be in the trend that we like to see. Plus, it's got that pullback and it's given us a great setup for a potential trade for Kohl's. So here's what I want you to do. I want you to follow the Google trade. I want you to follow the Baidu trade. I want you to create a trade for Kohl's, all right? Symbol KSS. And we'll look at what you did next week when we're back in the room. All right. What I got going on next week for you guys, I'll get into that in just a moment. I got this Let's Create Money Calendar trades for the week going forward as well. I created 2 of them for you. It's a green week, folks. So that's why we're looking at 2 bulls here. And if you're a new subscriber, tomsoptiontools.com, click on that. You can get a 7-day full trial. Next week, we'll do the review. We're going to look at our case studies, and special guest trader Christina Nugent will be with us. I like to call her the butterfly queen, and she is going to show you how you can take a trade like a Google that has $1,000 cost to it, that the call options might be $20 or the call spread might be $4, and you can get that butterfly trade down to where it's $1, $2. Something where you can cut that cost drastically and still maintain a bullish position or a bearish position or a neutral position using something called the butterfly strategy. You're not going to want to miss that, folks. Jay, any final points to be made before I call it a night?
No, sir, that's a wrap.
All right, awesome. Well, thank you guys very much for joining me for tonight. Again, we'll be back here again, same time, same channel next week. I'll have guest Christina Nugent in the house with us, so she'll be showing you some the ways that she goes about creating very special, incredible butterfly strategies. So until then, have a great night. I'll have a recording out to you real soon. Take care. We'll see you next week. Bye now.